I think a well-diversified portfolio, looking back at history, is your best way to succeed and achieve what you're trying to do for your retirement.
This is 401k Specialist Editor-in-Chief Brian Anderson, and this is a 401k Specialist podcast. It's quite rare for one person to manage a large cap mutual fund for a consecutive span of 25 years, but that just happens to be the case with our guest today. We'll talk to him and learn more about the Value Fund's unique contrarian approach right after this brief message.
In today's competitive retirement landscape, successfully navigating RFPs may be crucial for securing business opportunities. According to the 2023 Cirilli Report, U.S. Institutional Marketing and Sales Organization's 2023, statistics reveal that while the average RFP turnaround time ranges from 11 to 20 days, the success rate for many teams remains below 25%. The key to success often lies in understanding why RFPs fail. Master the art of the answer, answering the questions shown to win RFPs. To learn more, visit Invesco.com/art of the answer.
This summer, Kevin C. Holt, CFA, who is the Chief Investment Officer, U.S. Value Equities at Invesco, is celebrating the milestone of 25 years managing the Invesco Comstock Fund, which he has done as co-lead portfolio manager alongside Devin Armstrong since 2007. Long-tenured fund managers are certainly uncommon, but highly valued, bringing stability, a consistent investment approach, and a deep knowledge of the fund and its holdings. We wanted to find out more about this story, so we've invited Kevin back for a return visit to the 401k Specialist podcast. Welcome back, Kevin.
How you doing?
Doing great, thanks. As I mentioned in the intro, you were celebrating a rare milestone of 25 years managing the Invesco Comstock Fund. Just curious, what are some of the biggest highs and lows along the way?
Yeah, it's definitely been quite a ride. And what you've learned in this business is nothing is predictable. So whether it be, momentum phases of the market, whether it be politics, whether it be other geopolitical issues. So really kind of getting back, beginning of the 25 years, I'd been in the business as an analyst for about 10 years before that. But getting back to the fund was really beginning of the dot-com bubble. That was, fraught with its own issues in terms of a lot of companies without cash flow, and then a giant reversal. So then value came into vogue for 2000 to 2008. So I'd say that was probably the first period. That next period, post global financial crisis, really lasted about 12 years in terms of rates going to zero. I don't know if that's a high or a low, but it turned into a momentum market at the end of that with zero interest rates and a lot of excess investment. And then obviously the COVID period, which is kind of rebalanced the market, created some inflation in the market. So gave, value a little more balanced playing field with growth. But now the last 18 months, we're kind of in this AI growth phase again, along with some of the GLP-1 weight loss stocks. So pretty narrow market today. So it's always volatile. It'll always revert, but patience is needed. And that's one thing we try to focus on.
Okay, great. Tell us about how you identify value stocks. What's the screening process? And tell us a little bit about your contrarian strategy. Why is it such a unique approach?
Yeah, so I think starting off with being contrarian, it's part valuation, which is obviously identified in the stock based on the multiples. Cyclicals, we're looking at price to book and price to sales ratios. But, with the proliferation of technology and services, which has gone from maybe 20, 25% of the market up to, 50, 60% of the market today, it's required, and those are more cash flow oriented industries. So our process, we've always done this, is said, okay, looking at the sector and industry groups and what the characteristics are. For certain ones, we'll use price to book that are very cyclical and have worked historically. Other ones will use price to cash, enterprise value to sales. So I think it's important that you kind of know what pond you're fishing in, but that pond definitely has changed over time, again, with the proliferation. The other component is the behavioral psychology component. Do people like something or not? Part of being a value contrarian investor is people have a habit in life of getting overly optimistic or overly pessimistic. And when they're overly pessimistic and it matches up with some of our valuation framework, that's usually when we get really interested.
Okay. Now, people say there are growth stocks and value stocks. You say there are cheap stocks and expensive stocks. I'm curious about what the distinction is here.
Yeah. So, a lot of people will just say that there's, hey, a tech stock is a growth stock. And a lot of people will say that certain other characteristic, bank stock is a value stock. Well, that's a generalization. So we think the valuation ultimately tells us whether a stock is expensive or inexpensive. We love to buy growth businesses cheap. That's the best thing we can do. But value stocks also at a time and a place in the economic cycle and the financial cycle have very attractive upside too. So it really gets back to, again, understanding how to value these stocks. And, sometimes you'll pay up for a stock if the return on returns and the return on capital is quite high. Maybe you should pay a little bit more for it. So, it's really understanding value and what the characteristics of those businesses are in terms of return on capital and the sustainability of that return on capital, pairing that with the valuation that we prefer to be inexpensive. But again, not every industry or sector or stock is created equal, and it's our job to discern that over our analysis.
Right. And I think it may be a little surprising to people that Meta Platforms pops up as one of the top holdings in a value equities fund. How did that come about?
Yeah, so we really got fortunate on Meta. So if you think back into 2022, there were some privacy laws passed where you had to opt in for Meta to be looking at the data on phones. So that created a period for that 12-month period where advertising became a bit more difficult for them because a lot of people just didn't opt in. But we knew that social media was a great avenue for advertising, high penetration rates in terms of good ROI for those advertising on that platform. So as you anniversary that issue, we knew that business would pop back to a growth trajectory just off a lower base, which it did, but it really gave us an opportunity to get into that stock. And at the time we purchased it, the free cash flow yield was about 6% on Meta, and at the market was a 4% free cash flow yield at that time. So if you think about it, we were able to buy an incredibly good business with returns higher than the average stock in the market for a 50% discount. That was taking share in advertising. We believe would continue to take share over a sustained period of time, even though short term it was suffering some transient issues.
Wow, interesting. All right, so now I'm kind of curious about what are some of the sectors where you see opportunity right now, and what's changed that creates that opportunity?
Yeah, so what we've noticed, and I alluded to it in some of my opening comments, with the artificial intelligence stocks, AI stocks, and then the GLP-1 stocks, in the last 12, 18 months, you've seen the money go all in that direction. You've seen money come out of healthcare. Those stocks, which are good businesses over a long period of time, have underperformed. You've seen some money come out of consumer staple stocks. You've had some other issues within some of the financial stocks last year because of a couple specific idiosyncratic bank issues. But the areas that we're kind of finding value now more broadly, healthcare. We think a lot of the health insurance companies look particularly attractive at this point. We think some of the med device and even some of the pharma stocks, you need to be very selective in terms of who is in the best products, particularly for the pharma guys and pipelines moving forward. But we think those valuations relative to history are very attractive. Flipping over to the consumer staple stocks, haven't really been overweight staples probably in about 15 years. But the valuations, because of some of the concerns about consumption, with people eating less or drinking less because of some of the weight loss drugs, has driven valuations of these stocks to 15, 20-year lows relative to the market. So we think those are pretty attractive stocks. You have to be very picky about it. And we don't think that there won't be an effect on consumption, but we just think it's overly discounted, given the sustainability and predictability of these businesses over time. If consumption goes down, 5%, that's well discounted into these stocks. And we think over a 3 to 5 year horizon, they'll be very attractive relative return candidates.
Right. And I see that a couple of banks, Wells Fargo and Bank of America, are the fund's top 2 equity holdings. What are the key characteristics that make stocks like these attractive to value mutual funds?
Yeah, so the banks are in a little bit of purgatory because of the inverted yield curve at this point. That typically, it's been inverted for a period of time now, but it's not something that will stay that way. So it's our belief that the economy is in relatively decent shape. And so with interest rates up, the banks are able to earn more net interest income now than they have in the past when rates were zero. And we think as the economy continues to do better, or at least sustain itself, that the back end of the curve will move up, which will create a better environment for banks and a more typical environment for our economy. And we think if you look at the valuations, even a normalized PE or industry jargon price to tangible book value, which is really kind of your liquidation value, these stocks are 25 to 35% inexpensive relative to where they should be trading, given that their returns are typically mid to high teens, depending on the specific bank that we're talking about.
All right. Now, I kind of want to shift gears a little bit and finish up by talking a little bit about 401k plans. You obviously want to be well diversified with a mix of growth and value, but it seems like far too many 401k participants are still poorly diversified within their plan investments. Generally, I'm curious, what's the outlook for seeing any improvement in this area?
Yeah, so I do think if you take a step back, in what it's shown you is you have ebbs and flows in the market in terms of do growth stocks, work better than value stocks work better than growth stocks. So you don't want to try to time that. It becomes very unpredictable. I think diversification is paramount. I would argue, coming from a value perspective, now that we do have 2.5%, 3.5% inflation, we have more pricing power in the economy. So financials do better. Potentially, some of the commodity stocks will have pricing power and do better. So I think that it just goes to show you, if you look at history, you have these periods. So that really dictates that you need to be in value and in growth and create these well-diversified portfolios, because things ebb and flow in the market. It's tough to predict, will value outperform or growth will outperform. So I think a well-diversified portfolio, looking back at history, is your best way to succeed and achieve what you're trying to do for your retirement.
Interesting. Okay. Well, all right. Kevin Holt with Invesco, congratulations on hitting the quarter-century mark with the Invesco Comstock Fund. And thanks for sharing your insights about it today on the 401k Specialist Podcast.
Really enjoyed talking, Brian.
In today's competitive retirement landscape, successfully navigating RFPs may be crucial for securing business opportunities. According to the 2023 Cirilli Report, U.S. Institutional Marketing and Sales Organizations 2023, statistics reveal that while the average RFP turnaround time ranges from 11 to 20 days, the success rate for many teams remains below 25%. The key to success often lies in understanding why RFPs fail. Master the art of the answer, answering the questions shown to win RFPs. To learn more, visit Invesco.com/art of the answer.
Before investing, investors should carefully read the prospectus and carefully consider the investment objectives, risks, charges, and expenses. For this and more complete information about the funds, investors should ask their financial professionals for a prospectus or visit Invesco.com/fund prospectus.